think it's being recorded now.
Good afternoon, everyone. And Professor Dasgupta too, I think good afternoon is appropriate. And
no, it's evening. We are just 6 p.m. here.
6 p.m.
Good evening. And, I extend my warm welcome to everybody, and especially Professor Dasgupta and Professor Shikdar. And this is the 4th NKM lecture series that we are organizing. And this time, already all of you know that we are organizing some special lectures. So this is the 2nd lecture. And now may I request Dr. Gagori Chakraborty to formally introduce Professor Dasgupta and Professor Shikdar.
Thank you, Maushividi. The 2nd lecture in the NKM lecture series 2021 will be delivered by Professor Sudipto Dasgupta. He is currently a professor at the Department of Finance at the Chinese University of Hong Kong. He previously held academic positions at Lancaster University, the Hong Kong University of Science and Technology, the Jawaharlal Nehru University, the Indian Statistical Institute, and the University of Southern California. He has been the managing editor of the International Review of Finance since 2008 and is a senior fellow at the Center for Economic Policy Research and the Asian Bureau of Finance and Economics Research. Graduating from Presidency College, Professor Dasgupta obtained his PhD in economics from the University of Southern California and has been teaching finance since 1993. Professor Dasgupta's early work was on applied game theory and the theory of industrial organization. He worked on the design of procurement auctions and on takeover bidding environments. He later worked on topics such as the role of firm leverage on the worker, firm bargaining, on information sharing among competing firms in an oligopolistic market structure, the effect of leverage on product market outcomes, and so on. His more recent work includes papers based on empirical methodology, and he has examined issues such as the capital structure of firms, financial constraints and firm behavior, allocation of cash among alternative uses, reputational effects of large customer accounts on the loan spreads of supplier firms, whether the managerial labor market rewards top executives for their perceived ability, and so on. This session will be chaired by Professor Soumen Shikdar. Professor Shikdar is the retired professor of economics at the Indian Institute of Management, Kolkata. He obtained his undergraduate and master's degree from Presidency College and the University of Calcutta, respectively, and his PhD from the University of Minnesota, USA. He has more than 40 years of experience in teaching and research and has been a visiting professor at Shenzhen University, China, and the Institute of Social and Economic Research, Osaka University, Japan. Professor Shikdar has authored numerous research publications in internationally respected journals and books on macroeconomics and globalization released by international publishers. He has always been closely associated with the economics department of Presidency University and the erstwhile Presidency College. He has rendered generous support and cooperation whenever needed. So now I would like to request Professor Shikdar to kindly take on the session and continue.
Okay, thank you, Maushumi and Gagori. And it's a great pleasure for me to be chairing this session where Sudipto is the speaker. Actually, I taught Sudipto and Bashobi for a brief period when they were postgraduate students at the University of Calcutta. This is Kadakol campus. And our association actually dates from that time, and it has been an uniformly pleasant one. And I did not add anything to what you have said about Sudipto as a scholar. he has made outstanding contributions to finance and corporate governance. And today his topic is also, what's the topic? It's
Stakeholder governance.
Stakeholder governance. He's an eminent researcher in this area. So I now request Sudipto to deliver his talk.
Thank you, Shomenda and Gaguri. And this is obviously a tremendous honor. Mukulda is a larger than life figure, right? I mean, for many of us. So I'm actually reminded of an occasion some 45 years ago, 1976 or 77, I'm not exactly sure. I think it was 76. And Mukulda was giving a talk to undergraduate students in Presidency College. I don't know whether Shomenda, you were present at that time.
Yeah, I was.
Yeah. So, so Mukulda had barely turned 30 at that time, and he was already world-renowned mathematical economist. The talk, for the most part, went above our heads, but it was inspirational. And I think many of my batchmates, people like Devraj, Shubhashish, Vijit, Gautam, Kunal, all ended up in Cornell subsequently. And I think that visit of Mukulda was very important. I was going to Stony Brook, where Mukulda's, lifelong friend and co-author Topon Mitra was based. But in the end, I decided to stay back and finish my master's. And then I also worked for a couple of years in journalism before I went to do my PhD. So I'm not one of Mukulda's direct students, but Mukulda treats me like one of his students. Whenever we meet, it's a very warm exchange. And even recently, when he learned that I was going to do the presentation, he was very happy about this. So I mentioned this because I was told that this talk is going to be attended by undergraduate students as well. And I want to make sure that, that I can connect with the undergraduate students. Because, I don't know whether much of corporate finance is taught and how familiar the concepts are. So I'm actually going to start basically by introducing the concept, right, the topic, and then I will tell you where we are coming from in terms of the stakeholder governance idea. So let me share the screen. I'm assuming that you can all see my screen. Shomenda, is the screen visible?
Yes, it is.
Yes. All right. So the other thing is that, I don't mind questions as we go along. I'm happy to take questions. If I find that, it's better to respond at a later time, I'll simply postpone the response. But anybody, just jump in. Or if you feel like, if you're too shy to jump in, then you can send a message to maybe Shomenda via the chat session, and Shomenda can alert me if there's a question. All right, so the topic is on stakeholder governance. So let me introduce the notion of corporate governance first. Okay. So I think a good point of departure is the famous book by Burl and Means, who in 1932 pointed out that some problems arise because in a modern corporation, the publicly traded firms, owners, or shareholders don't actually run the companies, right? Companies are run by managers. So this is known as the separation of ownership from control. And the problem arises because the managers who run the company may have interests which are different from those of the owners of the shareholders. So for example, managers may destroy value by pursuing their own interests, and this is known as an agency problem. I mean, the concept of agency is a broader one, right? And it's not necessarily confined to a corporation, but this is what we're talking about. So corporate governance can be broadly understood as a set of mechanisms that ensure that the firm is run to maximize the interests of the owners or shareholders. And I will later on harp on this term interests, because that's where, some of the more interesting arguments are being made. How do we interpret interests? So then, given this separation of ownership from control, what recourse do the shareholders have to ensure that their interests are being served? So they can delegate supervision or advisory rights to a corporate board that they elect. They can have legal rights to make managers or board members, accountable and take them to court if their interests are being harmed. So managers and boards can collude to harm shareholders, or boards can simply be negligent. So in view of this, some people would define corporate governance as mechanisms to discipline a captured board. In other words, a board that basically caters to the manager. So shareholders also have some rights to set up or amend the corporate charter or company bylaws that affect how much say they can have on companies' decisions. They can also use their own voting power to approve, disapprove of, or accept or reject policies or procedures on which their approval must be sought by law. Now, this includes the right to nominate or elect directors, which gives them control over the board, some control over the board. They can instruct the board to align the interest of managers and shareholders by managerial compensation contracts. For example, give the managers a share of the profits or give them stocks in the company. Now, I should point out that there is a lot of controversy regarding the extent to which compensation contracts serve the interest of the shareholders and how much influence they have in how compensation is set. Now, a related concept is the notion of corporate purpose. So recall that we define governance as a set of mechanisms designed to ensure that shareholder interests are maximized, subject to certain constraints. Typically, shareholder interest has been equated to shareholder wealth. So the goal of the corporation is to maximize shareholder wealth or value. In other words, maximize the stock price. So this focus on profits comes from, Milton Friedman was an early champion of this doctrine, because profits are, the present value of profits is the share price, right? The present value of profits per share. So this model, this concept is often called the shareholder primacy model, where the purpose of the company is to maximize shareholder wealth or value. Now, Oliver Hart and Luigi Zingales. So Oliver Hart, by the way, is a 2016 Nobel laureate in economics. So they have recently argued that the objective should be to maximize shareholder welfare rather than shareholder wealth. Welfare here includes the utility shareholders derive not only from their own wealth, but the weight they assign to the social goals, reflecting the well-being of others. For example, shareholders may care about workplace safety, diversity, internal equity in the company, the impact of the firm's operations on the environment. So broadly, the parties, workers, customers, suppliers, the community, society, who are impacted by the firm's policies are called stakeholders. To the extent that shareholders care about the impact on corporate policy, impact of corporate policy on stakeholders, a more relevant model for corporate purpose might be to maximize shareholder welfare. Now, but the question that immediately comes up is, how do companies know what the shareholders want? Is profits are easy, right? But more broadly, what do they want? Right? So here is one way in which this could be achieved. So a company announces a set of stakeholder-friendly policy goals. Shareholders who value these policies for example, assign weights to the welfare of stakeholders, even at the expense of profits, will buy the company's shares, while those who like pure profits will sell their shares. So basically, the new owners are the ones who support the policy, and the ones who do not will have exited. The risk here is that the latter group may have to sell their shares at a discount if there is not enough appetite for these policies. So they may end up suffering economic losses, and they may take the manager or the board to court. And courts in many jurisdictions uphold this shareholder primacy idea that we talked about. If profits suffer, boards are in breach of what is called the fiduciary duty to the shareholders, duty of care and duty of loyalty to the shareholders. So to implement these policies, companies need to tread very cautiously. So they would need to make public statements and observe the stock price reactions. So if they say that, if they announce, and CEOs have been doing that very recently, for the past 5 years at least, that if they announce that they are going to adopt certain types of stakeholder-friendly policies, the stock price goes up, then the shareholders like it. There's an appetite for those policies. They could communicate with shareholders, for example, via investor conferences, which are very common. They can base policies on voting outcomes of shareholder proposals on stakeholder-oriented issues. So shareholders might propose, what is called, for the company to adopt a resolution which is stakeholder-friendly, and then that would be subject to vote, right, of the shareholders. And if the proposals are accepted, then that suggests that, again, the shareholders like that sort of policy. So I should mention here the notion of enlightened shareholder primacy. So this idea of stakeholderism is different from enlightened shareholder primacy. So companies may realize that taking care of stakeholders is actually good for them. For example, having employee-friendly policies may increase worker productivity and help attract the best workers. Long-term contracts with suppliers that cannot be negotiated or terminated easily by the customer may encourage suppliers to invest more in innovation that benefit the firm. However, proponents of stakeholderism would argue that enlightened shareholder primacy does not go far enough. For example, the profit motive is not going to address problems of externalities. For example, the effect of harmful emissions that shareholders may also care about. So in 2019, a key moment occurred for this drive towards stakeholderism. So there's an event held every 2 years called the Business Roundtable, which announced a new statement of corporate purpose. So this was signed by 181 CEOs of companies with combined market capitalization exceeding $13 trillion US. So to put this in perspective, the GDP of the entire US economy is 21 trillion, and that of India is 3 trillion. So this is a very large sum of value under management by these CEOs. So who pledged to lead their companies to the benefit of all stakeholders, deliver value not just for shareholders, but also to employees, customers, suppliers, and communities. So this was hailed as a major milestone in the evolution of the modern corporation. But the question is, does that work? The proposal has actually generated a lot of debate. So for example, Lucian Bebchuk is a lawyer in Harvard Law School, joint appointment with the economics department, who has been very critical. The point is that stakeholderism empowers stakeholders, obviously. But it only works if there is convergence of interest among the stakeholders. So stakeholders can disagree on the share of the pie that each should have, right? Just think of strikes. Now, even under shareholder primacy, right? Managers have a tough time, mediating between shareholders and workers, right? Now imagine that there are a bunch of other stakeholders, all of whom have a claim on the pie. So this is going to become very dysfunctional very quickly, right? If they're all trying to claim their what they think is their rightful share of the pie. So they may also have different horizons, short-term versus long-term interests. And this is going to play an important role in what I'm going to talk about later today. So some have argued that CEOs are keen to sign on to stakeholderism because it helps them reduce accountability to shareholders. So they can say that, we didn't perform that well, the stock price didn't perform that well because we are pursuing social goals, right? Or we are pursuing the interests of stakeholders. So agency problems can be defended as serving the interests of certain types of stakeholders. And again, this is a perspective that will come up very starkly in what I'm going to talk about. So all of these can cause frictions, undermine capital raising, firm performance, and survival. And here is sort of the punchline, right? In the end, accepting stakeholderism may not be in the best interest of the stakeholders themselves, because if the company doesn't survive because of these frictions, then how does it help any of the stakeholders? So I'm going to talk about a paper, right, that we have recently written. And this is co-authored with Shantanu Banerjee, with a former PhD student of mine. He's now a full professor in Lancaster University. And with Rui Shi, who's a postdoc who's now working with me in the Chinese university, but he was Shantanu's PhD student at Lancaster. So I'm now in a situation where I have great grand PhD students. So my PhD students of my PhD students of my PhD students are actually working with me. So this is very focused on a particular issue, but the main objective is to show some of the problems that can come up with stakeholderism. But this is also a good time for me to pause and see if there are any questions. Showing anything on the chat?
Let's see. No, nothing on the chat. So I guess you can continue.
All right, great. So let me talk about the paper.
And by the way, Mousumi, how long can Sudipto continue? 1 hour? Or Gagori?
Yes, sir. It can be continued for 1 hour.
Okay, fine.
Okay.
I was actually counting on an hour and 20 minutes or something. Is that
fine.
too long?
Oh,
I mean, if I can stop earlier, I'll stop earlier. But because I'm going to give a longish introduction, let's see how we do the time.
Yeah.
And
no problem.
This includes Q&A, is that right?
Yeah. 1 hour, 20 minutes is fine, Sudipto.
Including Q&A, right?
Yeah, okay. Yeah, fine.
Okay. Right.
Including Q&A, 1 hour, 30 minutes. Yeah.
Okay, fine. That'll be perfect. Okay. So let me tell you what we do in this paper. Okay, so we provide evidence on the role of an important class of stakeholders, downstream customer firms who account for a significant fraction of an upstream supplier firm sales. Okay. So we have customer firms and supplier firms. So supplier firms are the upstream firms, and the customer firms are the downstream firms. They're further up in the production chain. And some of them are selling directly to, consumers. Some are selling to other, customer firms. But that's the setup. So the sample comes from US suppliers and customers that are publicly traded. So these are US firms which are traded publicly in stock exchanges. So these have been extensively studied in the literature. I myself written several papers using this data. So according to regulation SK and SFA 131, if you're not interested in the specific regulations, so suppliers need to disclose sales to and the identities of customers, accounting for more than 10% of the sales. So these are all major customers. Now, in addition, there's a new database that collects information on customers and suppliers from numerous public sources. So we we use this data as well. So I want to, because I'm going to talk a lot about innovation in this paper. So let me talk a little bit about patents and citations. So patents are, a patent is an exclusive right granted for an innovation or an invention. It can be granted to an individual or to a company. And here we're going to focus on companies. Sometimes it can be granted to both, but the legal right would really belong to the company. So it's a form of intellectual property. The patent guarantees that no one else can use the invention for commercial purposes. However, it can be licensed by the owner to another party. It's usually granted for a period of 20 years. Now, citations these are actually not like academic citations. You write a paper and then other people, so you cite some other papers and then in the future, other people cite your paper. So it's exactly like that. So when a new patent is filed, the inventor references the known prior art and explains how the new invention represents an advance over this known prior art. So it's in the interest of the innovator to cite other patents. So the nature of innovation is often classified based on the type of or number of citations. So backward citations are other or earlier patents that a particular patent cites. So if I'm citing past patents, then these are called backward citations. Now, these citations are often used to characterize the novelty of the patent. And I'm going to talk more about this a bit later. But this is just an introduction. So if the patenting firm cites its own past patents mostly, or patents that cite its own past patents, then the innovation is not considered that novel, because we are basically citing what is already known, what has already been developed, and is more in line with what the company is used to doing. This sort of patents are called exploitative patents because they develop a known art. Conversely, if the percentage of such citations are relatively small, that means you're citing not patents that you have not previously cited that much, or other people have cited you have not cited that much, then this is considered novel. And these patents are called explorative. Forward citations, on the other hand, are later patents that cite a particular. So often this is a measure of a patent's impact or value, right? We all in academics, we count citations, right? These are all forward citations. How many times has my paper been cited? Gold Scholar and so on. So this is the same concept here. We're not going to talk too much about forward citations in this paper, but it's mostly the backward citations and in particular, how it's used to classify exploitative and explorative. So let me give you some basic facts about this data, suppliers and customers. The customers in our data are much larger firms, on average 10 times as large as the suppliers. On average, the relationships last for about 6 years. The suppliers spend about 10% of their total assets, or the value of the total assets, on research and development, R&D. They innovate in technological areas similar to the customers. They generate 1 patent per year, and about 10% of their own patents cite the customer's patents. So they are quite innovative, but they're basically innovating in line with the customer's interest. So they engage in what is called relation-specific investment, or RSI. It is customer-specific and valuable mainly to the customer, but not as valuable outside the relationship. So this is a key concept. And one good measure of this RSI is the extent of exploitative, non-novel versus explorative innovation that we do. So we want to know, as an important class of stakeholders, right, how principal customers influence supply. So we are going to focus on how the supplier firms are affected, but the customer firms' influence importance weakens for reasons unrelated to the supplier. So suppose the influence weakens for some reason, then what happens to the supplier? Okay, that's what we want to know. Specifically, we will examine what happens after financial fraud by a principal customer. So these fraud revelations are significant events for the customer and are associated with about a 10% loss in the market value on average. So stock price drops by about 10%, which is actually a pretty huge impact on announcement, on revelation of the fraud. So let me summarize the findings. And some of these findings are, the initial set of findings are expected, but then there are some real surprises. That's what I'm going to talk about for the rest of the talk. So what do we find? Let me give you a quick preview. So after customer fraud is revealed, the suppliers, they invest less in R&D. Okay, one of the main customers is gone, right? They produce, but that may not be as obvious as it sounds. They produce fewer patents. They move their innovation areas away from the fraudulent customers areas. Okay, they engage in riskier novel innovation. Okay? So that all of this is understandable, right? Because if your major customer for whom you were mainly doing the innovation is now weakened, then you want to move away from that customer. So you want to now engage in novel innovations, not necessarily relation-specific innovation, which is meant for the customer. But maybe your overall innovation activity is also going to go down because you're going to do less R&D and you're going to produce fewer patents. So this is not totally unexpected. Some of it is, but not totally. But here is a surprise. Within 2 to 3 years, relative to control groups, these suppliers experience faster sales growth, attract more principal customers, have higher Tobin skew. This is a measure of value per unit of capital, which I will talk about later, and lower firm risk. So actually, these firms do better, and they also become less risky. They become safer. Okay. That is surprising. Over a 10-year period, they experience higher exit hazard in the first 3 years, but lower hazard thereafter. So the immediate impact is that more of these firms fail, but thereafter, the survivors out-survive the control group. And over a 10-year period, they're 4% more likely to survive compared to the control group. Now, the baseline survival failure, the baseline failure rate here is only 12%. Right? Only 12% of the firms survive. This 4% higher survival rate is actually quite significant, right? Economically quite significant. So we provide evidence that a shift in innovation style from exploitative to explorative innovation improves the survival likelihood. So let me talk a little bit more about this innovation style, because that's one of the key drivers of the surprising results that we see. So as I mentioned, innovation can be either explorative or exploitative. Okay, this is a definition due to March in 1991. Explorative innovation, or more broadly experimentation, involves search, risk-taking, and experimentation with new technologies or new areas of knowledge. So it's risky. Exploitation, or more broadly developing known opportunities, on the other hand, is the refinement of existing and familiar technologies. So let's say you are innovating for your principal customer, and then you improve an input, right? You're a supplier manufacturing parts for a car manufacturer. Maybe you have a better, better airbag, for example, right? Safety device. So that would be an example of exploitative, because you're basically using traditional known know-how and just developing it a bit more. But explorative would be, explorative would be electric cars. Right? So exploration may perceive to be riskier in the short term. Right? In the short term, it's riskier. But there's no guarantee of success. But once successful, it can enable a firm to generate more diversified revenue streams, or create niche markets which are more immune to competitive threats. Right? So you're going to find something unique. If you might need to do this for several years and have no success, but success would be likely after some years, if you keep on doing it. And once you are successful, you're going to create a niche which will be more immune from competitive threats. So this raises an interesting issue for the choice of innovation style. So these people, Gormley and Matza, argue that many corporate decisions by managers are guided by a particular type of agency problem. They call it the play it safe motive. So this is the idea that managers, they value their jobs. They don't want to lose their jobs if the company fails. And therefore, they would not take on risky projects. Even though they may be better for shareholders, they would not take on risky projects. Okay. So we are basically, taking a similar view, but there's a time horizon issue here, which makes a major difference. So if supplier managers have short horizons and they prioritize short-term safety, they may prefer exploitative innovation over explorative innovation, because explorative is safe. Exploitative is safer in the short term than exploitative, but exploitative is likely to be prove safer in the longer term. So doing exploitative innovation makes the firm safer in the short term, but less safe in the long term. So if you think of cumulative failure rates, then you might expect to see something like this. That so explorative is going to lead to higher failure in the shorter term, but because it will eventually succeed and give you niche markets or attract new customers, right? In the long term, it will lead to lower failure rate. So it will be safer in the long term, but riskier in the short term. So later on, I'm going to show you that our data generates a graph exactly like this. So the incentive for managers to prefer, to prioritize short-term safety exists even in the absence of major customers, but is going to be exacerbated for firms with principal customers. Why is that? So I'm going to make that clearer in a couple of slides. So first of all, let me point out that managers have short horizons. So in the US, typical CEO tenure is 6 years. So CEOs of small firms typically move on to non-CEO executive positions of larger companies fairly quickly. So holding on to a major customer for a few more years can be extremely beneficial for a supplier CEO's next career. They don't want to risk relationship with the customer because that could be very bad for the career. So engaging in more relation-specific innovation could be one way to hold on to a principal customer longer. Now, customers are likely to use the promise of a relationship continuation and/or the award of a new contract as a carrot to demand more relation-specific innovation that benefits them. But the customers cannot commit to a long-term relationship with the firm because innovation is typically not contractual. So this creates room for what is known as opportunism. So customer can walk away and does when it is opportune for it to do so. For example, another supplier comes up with a different innovation, which is better, right? Or the customer changes its model or make of the product. Then it can dump the supplier, right, and move on. So there is no commitment in the relationship to, so it's not going to be long term. It's typically not. Therefore, customer-specific innovation does not create long-term shareholder value. So supplier managers' preference for short-term safety can thus lead to inefficient diversified innovation. And this is happening because the customer has a hold, so bargaining power toward the supplier. And this leverage comes from the fact that supplier managers are extremely sensitive to short-term safety. So let's talk about the setup a bit more. As noted, customer fraud revelations are associated with significant market value loss for the customer. It's primarily a shock to the reputation and trust of the customer. Customer fraud is often associated with significant personnel changes, managerial moves, managers are fired, other, at various levels, but the top and at the divisional levels, managers are fired. So new managers may have little knowledge of implicit agreements with the suppliers, right? So maybe the supplier was doing relationship innovation under the implicit promise of a new contract or continuation of the relationship. But now all those people who made those promises are gone. So now there's no guarantee that these implicit promises will be honored. So the question is, what type of shock is this for the supplier firm? Is it possible for the supplier firm to benefit from this, or is it really bad? Right now, it will turn out that it's actually possible for the supplier firm to benefit, but the argument is quite nuanced. So I'm going to take you, and you have to put together the evidence to see what sort of hypothesis is being supported here. Right? So I'm going to take you through that next. So the first possibility is that the customer's bargaining power is weakened because it's now committed fraud, its market value has dropped, it's lost people, its reputation is damaged. It's going to find it difficult to attract new suppliers. So its bargaining power is weakened. So it is now more dependent on the supplier for relation-specific innovation products. It possibly offers price concessions. This is a positive shock to the supplier, shareholders, and managers. This is good news, right? This is what happened, what's going on. So supplier will engage in more relation-specific innovation and more R&D. And we will find that suppliers, shareholders actually do better. But we won't find in the data, this is going back to the results I showed you earlier, that the supplier will engage in more relation-specific innovation and more R&D. Just the opposite. It cuts down on R&D and actually does less relation-specific innovation. It does more explorative innovation rather than exploitative innovation. Okay? So this possibility, the plausible, is not going to be supported by our findings. So the second possibility is that the customer is impaired. Okay? It will have to scale down or not grow as fast. It may not be able to buy as much from the supplier. It may even default and go out of business. So this is a negative shock to the supplier as well as shareholders as well as the manager. It's not a good news for either, right? Because a trading partner is weakened, so they're not going to be able to buy as much. So the return from relation-specific innovation is lower, so less exploitative innovation, less R&D. So again, we won't find any evidence of a negative shock to supply shareholders. Supply shareholders will be shown to be better. However, we will find that there is less exploitative innovation, but only one of the implications is supported, the other one is not. So here is the third possibility. The supplier manager believes that once the fraud is revealed, the customer is more likely to behave opportunistically. So this is the trust issue we were talking about. The fact that there are new managers, there's some pressure to cut costs on the customer side. So investing in customer-specific innovation may not provide the same short-term safety to the managers as before. So this is a negative shock for the manager. Manager directs innovation towards new areas, less exploitative and more exploitative innovation. Innovation is riskier, fewer patents for the same amount of past R&D. Once successful, the supplier is able to broaden the customer base, enjoy higher sales growth. Exit hazard increases in the short term, but decreases over the long term. And positive shock to shareholders. So we are going to find support for all of these implications. So possibility 3 is what fits our findings best, right? Almost perfectly, right? So basically, the managers were too short-term oriented for their own safety, for their own career concerns. So they were doing investment that the customer prefers, but not necessarily investment that is best for the shareholders. But once the return from that type of investment is no longer guaranteed, they now are more interested in doing explorative innovation to attract new customers, because now they have no choice. So that's what they will do, and on average, we find that they are very successful. All right, so there's some caveats here, which I quickly will go over. So some of the new customers could be less important than existing customers that are not reported or not in the data. This is possible. And the explorative innovation could be aimed at building relationship with the new customers. So then it's more like explorative innovation. But it's still in new areas and therefore risky. Otherwise, the supplier would already have engaged in such innovation. So it's fine if you think that this is also in some sense an exploitative, but it's risky innovation. So that doesn't, negate our findings. So I think this is more subtle. The manager's reasons for doing too much exploitative innovation before the shock could be consistent with shareholder value maximization. Here is another interpretation of how bargaining power could be imposed by the customer. The customer would threaten to switch to another supplier. The current supplier does not do enough exploitative innovation, which could be harmful for the shareholders. But the customer also has to make relation-specific investments. So it may not be easy for it to switch immediately. And in fact, we find that supplier is able to increase sales to new customers fairly quickly. So we have to conclude that risk averse or uncertainty averse, and here we are talking about a concept which is known as ambiguity aversion, may make the managers blink first rather than take on the customer. So even though this may not be in the terminology of game theory, this may not be a credible threat. The supplier managers are so uncertainty averse that they don't want to take on the customer. Show me that you can punish, right? That could be too costly, even though the probability is small. And because they may not be able to compute that probability and cater to the customer's demands for relation-specific information. So we think it's an agency problem. It's not that the manager is acting in the best interest of the shareholders. Okay, let me quickly talk about the data. Firm-specific variables. So we need a lot of accounting variables, which are from a standard data and stock price data, standard database. You may or may not be familiar. CompuStat and CRISP are major databases, and the customer data also from CompuStat and from FactSet Revere database. The pattern data is actually the most interesting here, and now there's so much research on innovation and patterns. This data is now publicly available. So you can download it for free, and it's been extended to 2020. Now, the data on financial misconduct, the basic data for that is, when a firm is, there's an enforcement action taken, we get the data from the Security and Exchange Commission. So the kind of financial misconduct we are looking at are essentially cook the book type of offenses. Okay? Then we have to, because we are primarily interested in not when the enforcement action is taken, because that's typically 3 years later, but when the misconduct was first revealed to the market. And so these are called the trigger events that attract the regulator's attention and prompt informal inquiry and possibly a formal letter of investigation. Sometimes it's also reported in the press. So these are the examples of trigger events: are accounting irregularities, internal reviews, earnings restatements, losses announced by a firm or reports by the press, and revelations of regulatory actions. So all of this has to be hand collected. So this is a lot of work, but has to be done. So revelation of the fraud has been known to wipe off 20 to 30% of market value from firms. Now, in our context, we see a loss of, so on the left-hand side, you have the customer firms. You have a loss of market value of about 10%. These are the stock returns, and it's, we see stock returns drop a lot, from -5 one day before to -15% the day of the announcement. The suppliers also see a decline, but that plays out over time and is, the day of the announcement is actually not very significant. Okay, so our methodology, we identify 77 customer fraud regulations and 477 affected suppliers. So these are going to be the treated suppliers in our analysis. So these suppliers are located in different industries.
Sudipto?
Yeah.
Sudipto?
Hmm.
All these are American data? Or?
These are all American data.
Okay.
Yeah. Similar data is available for some other countries, but the fraud data is more difficult to get. But I think potentially this sort of study could be done for other countries. Okay, so the treated suppliers are matched with control group of suppliers. Same quartile. Oh, by the way, actually, this is a good question. So the fact set actually gives international customers and suppliers. So one of the databases we're using that is not in our analysis, but we because we only focus on the US firm because the frauds are easier to identify for US companies. The fact set review data gives you international sample of customers and suppliers. So treated suppliers are matched with control group of suppliers. And the matching is based on same quartile in size, leverage, sales. Leverage is the debt ratio. Okay. Firm size is measured by the book value of assets and receivables to sales in year -5. So 5 years before the event in the same 2-digit industry. So I don't know whether you're familiar with this industry classifications, but a 2-digit classification is a fairly coarse classification, but it gives you more sample. So in each cohort, observations are retained from year -5 to year +5. So we have a 10-year panel for each event. But because the suppliers are in different industries, for the same event, we get multiple cohorts because each supplier becomes a treated supplier, and then we match it with other suppliers in the same industry, right? So that gives you multiple cohorts. So in the end, we have 202 cohorts. Now, for robustness, we also report all results with all firms in the same industry without matching. So just pick the firms in the same industry, as long as they have a customer. Okay. Now, so some visual evidence, and I'll monitor the time. I don't want to go too much over because I can show most of the results via graphs or charts like these. I have a lot of regressions also, but I may not spend a lot of time on those. So the red line here is the growth rate of sales, year-on-year growth rate of sales to the principal customer, the fraud customer. Okay. And you can see that on the event day, which is day 0, right? Date 0, the -5% decline. There's a -5% of the sales, and it increases a little bit. Basically remains 0. Then it tapers off around close to 0. So there's no growth in sales to the fraud customer. Overall, sales growth suffers a little bit, but then you see this big jump around year 4, right? That's exactly what we will be picking up, and then further jump around year 7, 8. And this is all going to come from new customers that the supplier is able to attract because it now engages in more explorative innovation. And this is a comparison. So this is growth relative to year -6. Okay, so go back to 1 year before when the cohorts were formed, and you will find that they are pretty close, and basically on year 0, they basically have exact same long-term growth rate. But then the growth rate begins to diverge in favor of the treated suppliers. So these are the suppliers whose customers committed fraud. So they outperform in terms of sales. And again, the jump occurs around year 3. So the empirical methodologies, I don't know whether the undergraduate students here are how exposed they are to regressions. I mean, so this has been my experience in India when I was back in, about 25 years ago, and I was teaching in ISI and even in ISI, but and also in JNU. Students are much more comfortable with models than with data. So I used to show regressions and they wouldn't register that easily as models would. I hope that's changed because there's so much new data now that most of the new research is now data-based. So here's the regression. So I denotes firm, C denotes cohort, T denotes time, year here. Okay. So this is the outcome variable, and there will be many. But this is called stacked diff and diff. So the cohorts are all stacked together. So this post ICT is a dummy variable, which takes a value of 1 if the period is any of the 5 years after the event, okay, after the fraud event. And then treated are the treated suppliers, right? So the post basically, compares, and then we have a bunch of controls that these are not mandatory, and then we have fixed effects for firms, year, and firm and year within each cohort. Okay, so basically, the coefficient beta 1 is going to compare, like if you hold treated to 1 and you look at a post taking a value of 1 versus 0, then you are comparing before and after, right? And if you hold post equal to 1 and then you switch treated from 1 to 0, you're comparing treated firms with control firms after. So basically, this is the standard diff and diff setting. All right, so you can look at the effect on R&D. This is R&D scaled by assets, and you can find that treated firms do less R&D after the fraud event. They generate fewer patents, and this is a variable which is we control. So this is the log of the 1 plus the number of patents minus the cumulative R&D of the past 3 years. And basically, if this number is lower, that means for the same R&D, you are generating fewer patents. This basically indicates that you are doing riskier R&D. Okay, so this number goes down, which means that you have fewer patents for given R&D. So you're doing riskier innovation. So this is what is called, you could call this a parallel trends test. So before the event, this is time 0, right? So this is the difference in R&D between the treated and the control, treated minus control. And you will find that the dashed lines are the 5th and the 95th percentile confidence intervals. So if the 0 is included, then the value is not significant, the difference is not significant. So nothing is significant before the event, but after the event, right, these differences become significant. And you see the same thing with patterns, but the significance really shows up with a lag. And that's what we expect, because it takes time to generate patterns, right? So first you step up your R&D, first you reorient your R&D, and then you generate in the patterns. The patterns really show up around year 3 or year 4. So we have a measure of technological proximity between the customer and the supplier. So this is the overlap of technological areas, and there are different categories of technology. So there are fine partitions, there are coarse partitions. So this is sort of you can think of this as a correlation coefficient based on the number of patterns generated in each technological area, okay, between the customer and the supplier. And you find that, so if you look at the proximity before and after, right, the proximity goes down with the fraudulent customers, but with the non-fraudulent customers, so there are other principal customers who have not committed fraud, there is no significant increase in the proximity. Now, this is the same result in a regression setting, so I won't spend time on that. Now, here is a key result. So we look at exploitative versus explorative innovation. And these are the same regressions, except that these have the columns 1 and 3 don't have the farm level controls. And some would argue that that is the better approach. Empirically, that's a better approach. But there's hardly any difference. So exploitative innovation goes down, but explorative innovation goes up. Okay, so they are now taking more risk and engaging in more novel innovation. Now, a key idea here is that, look, I mean, if the firms had no constraint on resources, right, they could go out and raise capital. There is no reason why they couldn't engage in both exploitative innovation and explorative innovation, satisfy the customer, but at the same time, address the innovation diversification that you need, right? So there must be some resource constraints. I mean, and this is the idea that there are financial constraints. You can't raise, a lot as much as you want. So it's sort of received wisdom that the smaller firms are more constrained than the larger firms. And these are called the financially constrained firms. So we use the firm, some sort of cutoffs for firm size as a measure of financial constraint. We find that the results are stronger for the financially constrained firms. Okay? So generally, even the so-called the less constant firms show some of the pattern, but the results are much stronger for the financially constrained suppliers. Now, here we are looking at how the customer base evolves. Very similar setting. So you will find that, so this is the number of customers. This is 1 plus the log 1 plus the number. You will find that the treated guys after the event, they attract more customers. But if you look at the dynamics, you see that this is picking up from year 3 after the event, right? And strengthens by year 5. So there's a gradual increase in the number of customers that you attract. You can look at sales growth, which should correspond with the number of customers, and you see a very similar pattern that these guys, this is year-on-year sales growth. They enjoy faster sales growth. Or actually, this is not year-on-year. Relative to, so log sales T minus log sales minus 6. Okay, so relative to year minus 6. But indeed, they also enjoy a much faster sales growth. Now, here is a measure that you may or may not be familiar with. I mean, in macro, you may have come across the concept of Tobin's Q. Tobin's Q is a marginal productivity of capital. So we can't measure marginal, so we work with average productivity of capital. But what is productivity? So how would we measure productivity? This is the present value of profits, and what is the present value of profits is reflected in the current share price, right? So you can think of this basically as the market value of the firm's shares and its debt per unit of assets. So this is a sort of a normalized measure of firm value. And you will find that if you include a dummy for the first 5 years after the event, then for the treated firms, the Q is higher, and it is even higher from year 6 to 10. So it jumps and it increases some more. So pictorially, this is how it looks. So around 0, right? It's slightly higher, but it may not be very. Before the event, it was actually lower. So the red lines are the treated guys, and they start to diverge. They really diverge around year 5, and they stay significantly higher until year 10. Okay. So it's good for the firm shareholders. The bad thing that happened is actually a good thing. Now, we also look at post-fraud firm risk, and risk is measured by the log of the variance of daily stock returns over the fiscal year. If the stock return varies too much, then the firm is subjected to more shocks, right? It's riskier. And this is a fairly standard measure, and we find that it is less risky in the next 5 years, and then becomes even less riskier in the subsequent 5 years. This is not, I mean, the graph doesn't really show that, so it looks to be the main effect is coming in the first 5 years, but, that's because this is more univariate. I think you get a better picture when you run the regression. So indeed, the risk goes up and stays up. Risk goes down and stays down. So I'm actually doing very well in terms of time. I should be able to conclude in another 5 minutes or so. So I want to show you sort of an ultimate test of, what happens that in the long term, this is beneficial. Right? So first of all, we want to look at, the survival or the failure rates. Okay, so we look at the first 3 years after the event. So this is a linear probability model where the dependent variable takes a value of 1. If the firm exits, and 0 if it survives in the next year, right? So you find that in the first 3 years after the event, this is no longer in a diff setting, but we still have the treated and the control firms. We follow them for 10 years after the event, right? So you find that the 3 years before, they have about a 2% higher probability of exit. It is a linear probability model. But in each of the 3 years after, in each of the years following the first 3 years, they have a 1% lower probability of exit. And you get similar results with probability. So this is consistent with the graph I showed you before, right? So because they have, they have to engage in more explorative innovation to find new customers. Initially, they're subject to more exit hazard, right? So the more of them exit, about 5% cumulative exit. So we are plotting the proportion of failed firms here. Right? So 5% more of the firms which existed at date 0 exit. But then over the longer term, that reverses, right? And we find that eventually there's a 4% wedge, right, between the proportion of firms that fail among the control group versus the treated group. So we want to argue, but this causality is hard to establish, that this survival success, counterintuitive survival success, has to do with the nature of innovation. Okay, so first we do a survival analysis for, this is the matched sample, and this is when the control group includes all the firms in the same industry as the treated firms. So this variable is the percentage of exploitative patents in the past 5 years, and this is the percentage of explorative patents in the past 5 years. Now, what we find is that the guys who do more explorative, they don't actually survive any longer, but the ones who do more explorative have a significantly higher. So don't be confused by the positive sign here, because this is a survival Cox model. What we care about is whether this coefficient is larger than 1 or less than 1. Okay, so less than 1 means that they are more likely to survive compared to the baseline hazard. Okay? And then this is a linear probability model where the coefficient, the sign of the coefficient tells you what's going on. And indeed, the guys who do explorative are more likely to survive. And we get very similar results, We get very similar results for the same industry, for the whole sample. So exploration leads to higher survival hazard. Now, we try to do some type of causal analysis. I'm not completely happy with it, and we probably have to do more on this. So first of all, this is a 10-year cross-sectional regression. Okay, so we look at the the dependent variable takes a value of 1 if the firm fails by the 10th year after the event. Okay. And 0 otherwise, 0 if it survives. And sure enough, the treated guys are 4% less likely to fail than, sorry, so look at the linear probability model, 4% less likely to fail than the control groups. Now we see that the treated guys, this is something we've already seen, they do more explorative innovation. And this is measured basically for the first 5 years after the event. If the firm survives that long, if it doesn't, then we look at the number of, the years up to the survival exit year. And then we convert this to a per year measure. Okay. So basically, we're finding that the treated firms do more explorative innovation. And here what we are doing is, in the next 2 columns, we are instrumenting explorative innovation because this is an endogenous decision, right? So they're subject to endogeneity. So we instrument it with treated. And we find that indeed, more explorative innovation leads to less failure, the linear probability model, and also in the proof. So that's pretty much it. I've actually managed to finish as planned, pretty much. So let me wrap up. Our evidence suggests that stakeholders can distort corporate policy when they have bargaining power and they cannot commit to long-term relationships. Managerial short-termism exacerbates this problem. Managers can justify self-serving policies as stakeholder-friendly when, in fact, they destroy shareholder value. So it might look good to do exploitative innovation, but actually it is not helping shareholders. It's only helping the customer. Ultimately, the frictions created by a stakeholder governance model may not be in the best interest of the stakeholders themselves, because if the firm is more likely to exit, then how does it help other stakeholders here, like workers, right? So enlightened shareholder primacy may still be the best, may still best serve the interest of the stakeholders. Okay, so that's all I have. I'm happy to take questions.
Thank you, Sudipto. Thank you, Sudipto, for a comprehensive but lucid presentation. Let's check if there are any questions. Okay. Sudipto, just one thing. One is about this short-termism of managers is crucial, right? And there, American managers are notoriously exceedingly suffer from the short-termism, right? So,
yes.
Do you expect it will be different for European or Japanese managers? And
not for Japanese managers are supposed to be long-term oriented, right? I mean, what managers, so in the US, the short-termism of the managers is attributed to shareholder impatience. So
I see. Okay.
So basically, the shareholders want to see good results. They want to see a high stock price, and therefore the managers often, invest less in long-term measures that would improve shareholder value to boost the short-term stock price. Think of R&D, for example. This used to be a major complaint. When US was lagging behind Japan, they used to argue that you guys are trying to boost the price by cutting R&D. Because if you cut R&D, then your earnings are higher, then the market likes
Right.
that better, and therefore your price is right.
Right,
So,
right.
So this is not so much that the managers are myopic, but it's that the shareholders or the market is impatient. But it could also be related to managerial short-termism, because the manager had was tied to the firm and was compensated with stock, which would remain illiquid. Then they would not be short-term oriented. And the point is that whatever stock-based compensation they are given, they vest very quickly, and then they can sell off these equity compensation components and free themselves from the consequences of long-term deterioration in value. So what I'm talking about here is slightly different, because the pressure is not really coming from the shareholder. The pressure is coming here from the manager's own career incentives. They want the results to be good until they land the next job.
Right. Okay. Okay. But how is it related to this broadening of the say the owners, the shareholders, say objective from pure profit maximization to welfare maximization? How is it related to that?
Yeah. So the point we are making is that stakeholder giving influence to the stakeholders, right, which is the crux of the stakeholderism argument,
Right.
may not be a good idea if there are certain types of frictions. The friction we are focusing on here is the stakeholder short-termism. So it might seem that you have a big customer. This customer is a very valuable stakeholder, right? And therefore, more power to the stakeholder is a good thing, right? You should listen to the stakeholder because
Right.
this is valuable. But what we are showing is that listening to the stakeholder can actually be very bad, because the stakeholder is going to look after its own interest because it's less long-term than the shareholders or other stakeholders. So it can be very bad for the workers, for example, if the firm quits, exits.
Okay. Okay. So that's a problem actually. Yeah, how to include all the stakeholders to the same extent or put equal weight on their interests, right? That will be very, very tough actually. Yeah.
Very tough. And then there are, other bargaining frictions, right? That's very hard for the managers to mediate, right? So each will want a share of the pie, and how do you mediate that? It's very difficult.
So, and going back to this Hart and Zingales paper, what was the logic? What is purely on the basis of principles or any hard evidence or?
No, so no, it's not. It's a theory paper. And it's not that difficult theory either. It's pretty straightforward argument that that we assume too much that all the shareholders care about is their wealth, but shareholders may care for more than wealth. They may have other goals, and this is actually becoming important, a very important issue in the US right now, worldwide actually, Europe and US in particular. And I'm doing some work on socially responsible investment, where
Right.
it plays a very important role. That in the US now, more than 70% of the ownership lies with institutional investors, right?
Right.
For example, mutual funds, pension funds, and so on.
Pension funds, right?
And it goes to these funds through retirement plans and so on, or direct investment by investors. And large amounts of money are flowing into institutional investors, which are considered socially responsible investors. So, and there have been studies, experimental studies, and other types of studies where investors have been asked about the social preferences. And they have said that no, we want, even if we get lower profits. This is more true of Europe than in the US, actually. Europe is extremely socially conscious, right? Investors.
Right, right.
We can give up profits, but we want some social outcomes, right? So there's clear indication that shareholders demand, broader. They have broader objectives and demand, require the managers to deliver on a broader menu than simply profits. I mean, this is controversial. Some people say that this is all a gimmick by the mutual funds to attract funds, and nothing really is going to happen. So very controversial. But I mean, there are some experimental evidence showing that shareholders prefer. Now, whether the mutual funds are catering to that preference and just making money by attracting funds, that is where the debate is. But there is no doubt that in Europe especially, but even in the US, there is now much more weight being given to social goals by the owners, right?
Good, good. Oh, okay. Okay, thank you. Yeah, anybody else? Nothing in the chat box. So, yeah. Moushumi, I guess we can assume that there won't be any more questions.
Yeah. Bhagwani, do you have any question in your chat box?
No question.
Okay. It's a different type of topic, generally, in our undergraduate and postgraduate curriculum, though we have a lot of finance in postgraduate. So only a few students are there from the postgraduate batch. Okay, so if no one has any question, Shominda, we can close the session in that case.
Sorry?
If nobody has any question, in that case, we will close the session.
Okay, yeah. So,
because people may write to Professor Dasgupta later if they have any question, or if they want to learn more about these things, so they can write.
Sure, I'll be happy to.
Sudipto, thanks once again, and looking forward to meeting you in Kolkata in presidency.
Yes, who knows when that will happen, but let's hope for the best.
Let's hope for it.
Let's hope for.
Thank you all. Thanks for listening.
Okay. Thank you.
Thank you. Okay, thanks. So I'll send you the recording link.
Yeah. Okay.
Okay. Thanks.
Thank you.
Yeah,
Thank you.
Thank you, everybody. Thank you. So we will close this session now, and we will come back around 6:30. 6:06. Okay. Oh, okay. So in that case, we have to come around 5:45. Okay. So our next lecture is from 6. So we will come back by 5:45.
Okay.
Mukulda also wanted to listen to your lecture, because he didn't met you for a long time. However, it was really midnight this time.
No, you can send him the recording, right?
Yeah.
The time is not good for Mukulda, right? It's
right.
Yeah.
in the morning for him.
It's almost good midnight.
Early morning, I guess. No?
Early morning.
Early morning or yeah.
Yeah,
Okay, so
I'll send
thank
you.
you, everybody. Okay, thank you once again, Sudipto, Shomenda, and all of our faculty members present here, students, faculty from outside, and hopefully all of you will come back, by another, I think, 45 minutes.
Okay. Bye.
Okay, bye then. Bye.
Bye.